Let me tell you the single most powerful piece of advice I've ever heard about building real wealth. It came from a millionaire I admired growing up, my mentor during my younger years, someone who had what my family didn't. Back then, my parents were struggling financially, and I was terrified I'd never have enough to live the life I dreamed of. One day, he looked me straight in the eye and said, "Everyone wants to be a millionaire, but nobody talks about how brutal it is to reach that first $100,000. Focus on that. It's the hardest part, but it changes everything." And honestly, that line never left me. If you're thinking about giving up on your goal of building wealth, don't. Welcome to this mini-series on sketching finance. I'll break down why the first $100,000 is the toughest milestone in wealth building and why it's crucial not to quit. In my upcoming videos, you'll hear real cases of people who crossed the line, the strategies they used, and in the final episode, I'll share a clear roadmap on how to save $100,000 even faster. Today we'll explore what science says about the difficulty of reaching $100,000 and how you can push through. You'll discover the impact of compound interest, and by the end of this video, you'll understand why your struggle is normal and why persistence is key. Stay tuned as we unpack the journey to financial freedom together. All right, let's get into it. Imagine you're 28, working hard, saving religiously every month. You check your finance app and see a $12 gain. All your saving efforts equate to a few extra dollars. Meanwhile, your feed is full of overnight wins and people announcing their latest big investment. It's hard not to wonder, am I even cut out for this? You feel discouraged. The truth is, early stages of wealth building are incredibly challenging. Almost half of all business fail within their first 5 years of existence. The world of personal finance has its own dropout rate. Studies show that nearly 89% of people stop saving or investing within just 2 to 3 years, usually right before their progress is set to explode. This quit point is the silent killer of financial independence. But understanding the science behind human psychology can make all the difference. In the next part, we'll expose the 4 psychological traps that push people to quit and how you can avoid them. Let's start with the so-called compound interest paradox. There's a mathematical reason why it feels so hard. Compounding interest is exponential, not linear. Look at this animated chart of your wealth over time. At first, it barely rises, a stubborn, almost flat line. Then it suddenly tilts upward. Logically, you understand the concept. Invest and let compounding do the work. But emotionally, it is demoralizing to wait for so long. Imagine you've put away $500 month after month, and all you see is maybe $12 in growth. You're thinking, seriously? I put in $500 and only gained $12? The hard work that goes into producing the $500 to invest feels much more significant than the $12 you get out of it. Visualize pushing a massive boulder uphill. The beginning requires immense effort for little movement. Progress is slow and grueling. But what you have to realize is that this slow, almost boring growth is actually the bedrock of exponential growth that follows. Next up, the comparison trap. Think how your social media feed is flooded with overnight crypto millionaires and day trading success stories. The images we see combined with our culture of instant gratification, makes your steady climb look painfully slow. What you don't see is that all major success stories required years of upfront work before the crops could be harvested. That's because genuine and sustainable wealth accumulation takes time and patience. Now, let's look at the quit point crisis. Did you know that most people abandon their financial growth plan between the 18th and 24th month? Statistics reveal this as the moment just before their efforts would finally pay off significantly. If you're at month 20 of your wealth building journey and feeling frustrated, stay in the game. You're closer than you think. Lastly, there is a thing called the analysis paralysis effect and the linear expectation fallacy. Expecting straight-line growth guarantees disappointment, but the constant overthinking of your investment choices and shifting of strategy resets your financial growth. You're essentially starting that boulder push all over again. Historically, the US stock market has returned about 9 to 10% annually over long stretches. But most investors don't capture that because they jump in and out. Whatever your status, whatever you do, please remember, reaching your first $100,000 isn't just about the money, it's about proving to yourself that you can build something big. Why is $100,000 such a big deal? Up to this point, your progress is slow and gradual, then suddenly it shoots up. The inflection point, or what investors call the hockey stick moment. To make it more visual, let's assume you are investing $500 every month, which adds up to $6,000 per year. At a 7% annual return, it takes you 20 months to reach your first $10,000. But from here, each $10,000 milestone gets faster because your money is now making money. To get from $10,000 to $20,000, it will take only 17 months. From $20,000 to $30,000, add only 14 more months. By the time you're moving from $90,000 to $100,000, it takes just 10 months, which means roughly half the time it took to hit your first $10,000. Let's now look at how much interest earnings contribute to total growth for each year. In your first year, you contribute $6,000 and interest chips in just $420. That's 93% your cash, 4% interest. But as your balance grows, the roles reverse. In year 2, interest adds $870. Now it's 13% of your growth in that year. In year 3, interest contributes already 18%. And in year 11, the year you'll hit your first $100,000, your interest contributions will have grown to a significant 50% of your total growth. This is the turning point. The same concept applies to scaling from $100,000 to $1 million. With the same investment assumptions as above, it takes you about 11 years to reach your first $100,000. But that's already 1/3 of the total time it takes to reach $1 million. Because in those early years, you're doing most of the work. Around 74% of that first $100,000 comes from your own contributions. But to reach $1 million, only 17% of that million comes from your wallet. The remaining 83% is money earned from interest. To make this even clearer, let's zoom in on the final stretch, from $900,000 to $1 million. It takes just 12 months and you only contribute $6,000. The market adds $94,000. That's 94% interest, 6% effort. Bottom line is, the first $100,000 is the hardest and the most important. Once you cross that $100,000 threshold, the game changes. Climbing to $100,000 might feel like scaling Mount Everest barefoot, but it doesn't have to. In my next videos, I'll be sharing detailed strategies to avoid quitting. However, I wouldn't want to end this video leaving you with negative thoughts. So here are a few tactics on how to keep pushing when the going gets tough. First, shift your mindset. Stop obsessing over dollar amounts. Start tracking percentage growth. Watching steady 6% or 7% annual increases is way less stressful than watching every tiny dollar gain. Monthly reviews of your percentage returns give you a panoramic view of your climb and keeps you motivated. Next, let's talk about consistency. Automate your savings and investment contributions. Let dollar cost averaging work its magic over time. Dollar cost averaging means buying assets with equal amounts at regular intervals. This strategy, regardless of market swings, almost always outperform those who try to time the market. My third advice to you is to ignore the noise. Don't let the fear of missing out define your investment strategy. Stick to a simple, reliable investment strategy and avoid the temptation to jump on every hot stock tip. Wealth building is a marathon, not a sprint. Fourth, celebrate progress milestones along the way. Treat your first $10,000, $25,000, and $50,000 like level ups in your own personal finance game. Share your progress with an accountability partner or use an online tracker. Gamifying your journey gives your brain the dopamine hit and preserves your commitment. And here's the last crucial mindset upgrade. Forgive your financial flubs. Everyone active in the stock market makes mistakes. If you veered off course on the path to financial independence or switch strategies, acknowledge it, learn from it, and move forward without self-reproach. Look, here's what I need you to understand. Reaching $100,000 is undeniably tough. Yet, this is a natural and necessary part of the journey. Keep pushing, because once you cross that threshold, the dynamics of money growth change dramatically. Every sleepless night wondering if you're cut out for building wealth, every moment you've questioned whether this compound interest thing is real, that's exactly what every successful wealth builder has experienced. The only difference? They didn't quit. Those boring months where your money barely moves, that's the foundation being built. Once you cross that 100,000 threshold, everything changes. Past this point, building wealth gets exponentially easier because now the numbers are finally big enough for compound interest to feel real. Now, I turn to you. How far are you on your journey to $100,000? What challenges are you facing? Share your experiences and support one another in the comments below. Let's celebrate our struggles and perseverance together. If this video was insightful, please like it to help us grow. If you feel we can do a better job, please share it in the comments. I am just looking for your honest opinion. Subscribe for my coming episodes on people who reached $100,000 and a roadmap I assembled just for you, detailing how I'd go about earning my first $100,000 in 2025. As always, your support, in whatever form it may come, means the world to us. Thanks for watching.